Hey guys, welcome back to the Results Junkies podcast. We're going to talk about AI shock of shocks. We're going to update on an OpenAI story that we talked about a few weeks ago in terms of defamatory language and how OpenAI had a clause in their agreements that would cause vested shares to be reclaimed by the company if you said anything bad about the company. We're also going to talk about who's actually making money in the world of AI, and I think this goes to reinforcing an earlier philosophy that Paul and I had about the winners and the losers in the AI space. But just at the outset of the show, there was a question that Paul asked me in the pre-show. Before we get to that, I wanted to note for folks, I am still trying to invest in 10 travel startups a year. We talked about this over the last handful of shows, but if you are a travel startup or if you're travel adjacent and you're looking for fundraising, hit us up at show@resultsjunkies.com. I am on social media at Pizza in Motion. He is at Results Junkies on all of those social media channels. So Paul, ask me that question again about mint.com.
Well, yeah. So to set it up, Ed has been talking to me for months now about reorganizing my credit cards because he says I'm leaving all these points on the table. And to be clear, at the time when I first started talking to you about this, I only had two. One personal Amex Platinum that I've had for almost 20 years, and then one business Platinum Amex that I've had for about 20 years as well. And so then, you in no short terms or whatever, just said, hey, based on your settings or your spend and your family now and all that, get this, get that, downgrade this. You told me step by step. Anyway, fast forward a few months, I was using PointsPath this morning to look at some flights for a little trip for Dana and I. And I noticed that
shameless plug for a company that's in my portfolio, PointsPath, our buddy Julian, who I am in his round.
Which may or may not be available on my AngelList syndicate, by the way, anybody that wants to invest in that. So people in black trucks with 3-letter agencies don't come tracking me down. But anyway. The point of it is that I was looking for a flight. I noticed that it gave me an option it told me whether to use points or cash based on those itineraries. And when I clicked through, I didn't notice Amex in that list, even though I thought vaguely that Julian had told me this. And where I went with this was, I thought it was a bug. And as soon as I sent you the screenshot, I don't even think the picture loaded for you. You knew immediately that I was talking about Amex and United, and you knew right off the bat they were not connected. And so it just begs the question for me of almost 20 years ago now, we invested in a company called mint.com, which got acquired by Intuit. And for those of you that don't know, it was one of the earliest but most successful companies that basically did one thing really well. You as an average consumer would connect it to your bank account for free. It would watch your daily spending habits, and if it detected that there was a better opportunity for you, you would just literally with one click, it could fix it for you. So, hey, AT&T Wireless is charging you this much based on your usage. We think you should switch to Sprint. Click this and we'll do it for you. And so anyway, and again, that did very well, got acquired by Intuit, and ironically now 10 years later getting sunsetted because it's getting integrated fully into the business. But the question I asked you now that I set all that up was, why doesn't this exist for credit cards? Because as I've gotten to know Julian, the founder of PointsPath, a little bit more over the last couple of years, it seems to me that these points represent such a large amount of money on the balance sheets of all these different players, whether we're talking airlines, credit cards, whatever. It just seems like it's surprising me. Anyway, let me stop there. Why doesn't a mint.com exist for this yet?
So two answers. First off, there are some bad versions of mint.com that do exist. These are what I would call, dumb's the wrong word for them, but products that aren't as fully integrated. So for example, there's a product called the Ward Wallet, which will help track your balances, but it's been blocked by a number of airlines in terms of being able to get direct information. Why? Why there's no mint.com? So we've got to follow the money on this. And so I guess first off, for folks that are listening in or watching a video, airlines, for the most part, don't make most of their money selling you an airline ticket. They actually make most of their profit either selling miles or by selling ancillary services. So when you're on that final screen and there's travel insurance and rental cars and hotels, they earn commissions on all those things. And usually, profit on those is a much higher margin than what they earn on the airline ticket. So if we follow the money, the airlines want you to go through their booking flow to earn all that ancillary income. So their belief, generally speaking, and this is why I think travel disruption in the travel space has been hard up until most recently. The old school executives in the airline industry believed that if you went somewhere else to get your information, you weren't ultimately going to come to them to book, and thus they were losing out on chances to monetize your eyeballs. There are two sides to this argument. I believe that it's a flawed argument because at the end, the only place you can use your United miles to book a United airline ticket is the United website.
Right.
So you have to get to their funnel no matter what. And my personal belief, which is why I like products like PointsPath and another investment of ours called PointMe, is they ultimately help you understand what your miles are worth and how to use them. And if you're more likely to use the miles, you're more likely to go to the airline's website and you're more likely to engage and buy something else from them. Airlines have traditionally not found that this was the case. And so where in the Mint.com example, where there were either open AIs or relatively open AIs that Mint.com could write to show credit card transactions and bank transactions and stuff like that, the airlines have for the most part, closed off their APIs.
Yeah.
And part of that is fraud. There are people who will take those miles and they'll sell them to other people. In other words, they'll book a ticket for them and sell them. And so some of it is the airlines trying to chase the fraud path, if you will. But a lot of it is just that there's just less friction in the space that Mint operated in to be able to move information back and forth. And the organizations that Mint was pulling info from, banks, credit cards, stuff like that, just had much less of a walled garden or moat philosophy than the airlines do, if that makes sense.
So, yeah. I mean, I know this isn't the total topic of today's call. It's just, it just makes me, there's always, so I'm an optimist, right? So the way I think
Yeah.
about everything is what's the one thing that has to go right? And everybody else can sort out the 87 things that can go wrong. And I just, in this moment, as you're talking about that, I'm thinking about Honey, Join Honey, which was in a
Yep.
browser extension that got acquired by PayPal for $4 billion in 2019.
Yeah.
I use that thing every day, and I don't know, I'm sure they had to jump through, I'm guessing they had to jump through the same sort of hoops to figure it out. But anyway, I think this is part of the reason why I'm optimistic about companies like PointsPath is that, if you can find the initial wedge and buy yourself enough runway to then start testing out these other ideas, I think it gets very interesting very quickly. Like, and I'm just armchair quarterbacking here as an attorney for a moment. Amex probably has no vested interest in opening up an API to let third parties determine how many points somebody has or whatever, I guess. But at the same time, like, I'm really optimistic about this idea of using browser extensions potentially as the wedge in. So for example, and I'm making this up, and if Julian, if you're listening, it's like maybe down the road on the product roadmap is this idea where, like, when I open a new tab, at some point in the sign up flow or the onboarding flow for PointsPath, I can tell it, okay, I have an Amex card, I have a Built card, I have whatever. And then whether they build their own integrations or they use a third party, like I think like Plaid or whatever these other systems are,
Yep.
I can then give PointsPath third party access to those accounts. And maybe through the magic of, automated browsers and stuff like that, they could potentially on my behalf log in as me, figure out my points. I don't know. I'm making this up. It's probably harder than it sounds, but I don't know. It's just,
There are areas that are easier and harder in that piece, and PointsPath is already doing some of this. So, for example, if you were a Delta flyer, which I know you don't fly a ton of Delta, but if you hold Delta's credit cards, you get a 15% discount on booking award flights. United has a similar offering, but it's more inventory based. So, as a United card holder, you get access to extra inventory, but there may not be inventory in every flight where Delta sort of says, like, look, you just get this discount off of whatever the award price is.
yeah.
So
Yeah.
what PointsPath can do is if you're logged in on your Chrome browser that you have PointsPath installed on, if you're logged into Delta and it sees like the Delta website recognizes you have that credit card, PointsPath is on the way to showing results where it will say, hey, like, we know you've got a Delta card, so we're showing you the 15% discount rate for that flight. So there's a higher level of accuracy there. I mean, I think to be clear, like, I think the airlines are starting to come around to this. I mean, if you take American Airlines as an example, in any given quarter, they're right at break even on actual flying, and in some quarters they lose
Right.
money on the actual flying. So I think they understand that there are, larger cows, if you will, that are keeping the business going, and those cash cows need bigger funnels. So
Mhm.
I think it's how these different, companies convert, and I think this goes a lot back to the Mint.com world. I think PointsPath and PointMe, two companies that we're investors in, are doing this in a way that should be more conducive to what the airlines want. So, for example, like, I don't think any airlines are really anti-Google Flights. Maybe they're not hugely pro, but most of them are generally in favor of Google Flights. Well, PointsPath obviously integrates with Google Flights. So it's using an existing tool, and then it's injecting you into the booking flow for American Airlines or United or Delta or whoever you're booking. So
Right.
it's following a similar path that brings the airlines low commission revenue, i.e., they don't have to pay out a lot for it. And on an award ticket, they don't pay anything. So,
Mm.
I think this is changing, which is also why I'm more bullish on investing in travel in general. So,
Well, and I know this might be a good segue into our some of our topics today, but I think the one thing I'll just kind of add to this, and I don't mean to put you on the spot, but I think that like if you've taught me anything in the last 6 or 7 months, probably is that it's this idea that like those points carry value, and that's not something I believed or knew about until you kind of started beating me over the head with it. And I think this is the part where I don't mean to put you on the spot, but I think it was sort of like as I get into this point of having my kids a little older, like our kids were so young for a while there that just
sure.
it was easier to be homebound than on the road. But now we're getting to that point where it's like you know a, I can get a 2-year-old onto a plane for 2 hours down to Orlando and not think twice about it. And my point where I'm going with this is, and there's a compliment buried in here somewhere, is that like I think for people that don't know you, if they were to just follow your Instagram and you're taking these, and I'm doing air quotes, emergency trips to Disney, or you're taking the family to Australia or whatever, without context, it might seem to somebody that doesn't know this stuff that you're dropping tens and 20 grands of travel on a whim all the time. And I don't mean to put you on the spot, but I don't think you're doing that. Now that I understand now that I'm starting to understand how these points work and how you optimize your expenditures to to get the most points, it becomes much more in reach for the average person. And I guess that's my poorly articulated point of all this for anybody listening is that like, you know, there's just a ton of value in these points that we all don't realize. And to what you said earlier, if you just sort of follow the money, it's also kind of not in anybody else's interest, or it's not in these platforms' interest to tell us how much those are worth.
Right.
Because
Right.
on the off chance that we do want to spend them, it makes it more sticky. Like I'm on Mileage Plus, so now I can't really burn those points somewhere else. And on the flip side, like I don't know. Anyway, the point is though is that I just find I find myself in my free time now gravitating more towards, what else? What other money's under the table? Because we're not talking about pennies here.
No, we're not. I mean, this is a massive industry, and I think like the airlines want you to redeem, but they want you to redeem for things that are high margin for them. So
Right.
yeah, they want you to redeem at a penny a point to buy an iPad or a set of headphones or things like that. Or if you're going to buy, if you're going to use it for travel, they want it to be truly distressed inventory from,
Yeah.
Cleveland to Chicago on a Tuesday
Yeah.
afternoon, not not like when we went to go get you married in Paris,
Right.
international business class flights. And so that is sort of like the potential tension in these things is that, going all the way back to something you said at the very beginning of that blurb, I think what you're starting to figure out, which most people never do, points are a fiat currency. So they're like pesos or dollars or euros or whatever. They're just an alternate currency because you could take cash back and just take the
Yeah.
cash back from the card and go do whatever with it. That's why I always recommend to folks, like, if you're, and this is going to get a little nerdy, but we're looking to get essentially 2 cents in value per point, in that's if you're getting at least that, then you're getting at least the quote unquote 2% cash back you could have if you just got a 2% cash back card and you simplify all this stuff, and there's none of the other voodoo witchcraft math. Where you're starting to get to is this level of understanding the value of the points, and this is where the value of PointsPath and PointMe and a lot of other companies in this sector come in, is to say, hey, Paul, if you want to get 6 cents per dollar or 10 cents per dollar, So now you're getting a 6% rebate or a 10% rebate. Here's how you do it. And
Yeah.
and that's the to me, that's the upside of these tools. That's where I think they can help provide some level of disruption to this space. And because we can show this information on a screen, I think ultimately, to your point, like, it's a fiat currency, it's controlled by these programs, they can devalue it anytime they want. But you keyed on the thing that's the business strategy. They obviously want you to redeem for the what they consider their high margin stuff, or they want you to carry a balance on the card or whatever. And so they're counting on enough customers. Their business model is they're counting on enough customers to carry a balance and put a bunch of charges on there and revolve and all that stuff and redeem for headphones, so that when Paul or Ed or Julian or whoever redeems for business class flights to Paris, the the overall valuation, what they're paying out, is a good balance for them, and they make money.
Right.
So that's their model, and companies like PointsPath help customers get more value out of their points. You are starting to realize what your points are worth. You're more likely to redeem for something that's lower margin for the airline. So
Right.
net may be bad for the airline overall, but there's also all this consumer behavior that shows that when you redeem points, you're much more likely to spend more on that credit card. So
Right.
even when you're redeeming at something that doesn't make the airline a ton of money, you get that feel good euphoria and you want to charge more on the card, which ultimately earns them more money. So,
Right.
but I think let's pivot into AI before you run out of time today and talk about, we got a couple articles that I'll link to in the show notes. There's this general philosophy with AI that we've talked about in the show, where we really believe that they're AI kingmakers. Microsoft, Amazon, Google are heavily investing in AI, and will likely be winners in this space. And smaller companies are going to really struggle to gain ground. We've talked about this on the show a couple times.
Hmm.
Well, one of the articles that we're going to talk a little bit about today is this philosophy now that there are some companies that are that have more liquid shares, if you will, based on some mechanisms that are out there. So this article from TechCrunch talks about how VCs are selling shares of AI companies, and they're putting them in SPVs, or special purpose vehicles, which are sort of like publicly held companies, if you will, sort of like a different version of IPO. And when I sent this to you, your first sentence, and I won't give the whole thing away because I want you to riff on this, is, you said, this is wild to me, and I felt the same way when I read that, but I want our listeners and viewers to hear why this is so different for you.
Yes. So, yeah. So to set this up, I mean, look, venture capital is a power law driven model. So to put it really bluntly, for the sake of time, if you have got a winner in the portfolio or a potential winner in the portfolio, then common sense logic would tell you that, considering that that 90+% of your portfolio is going to get written off anyway, if 1 or 2% of your portfolio looks like a winner, you should not only hold on to those shares, but you should be doing anything you can to amass more of those shares. This is wild to me because it suggests that the opposite is happening, that they are divesting some of these investments and selling them. Now, let me pause there for a second and add one caveat. There has always been a little bit of behind the scenes liquidity happening all the time. An LP passes away and maybe their trust or their will needs to get liquid, or their estate has to get liquid, and so generally speaking, at least in my experience, has been that there's sort of an understanding that the GP will try to maybe provide a little liquidity by selling or introducing them to another party inside the LP family. So they don't try to let another LP come in. They'll just kind of like quietly say to the existing LPs, "Hey, we need to provide this one liquidity, blah blah blah," and that happens.
But to be
The
clear,
fact
this is rare. Like, this
they're
isn't. It's not
very
like you can.
rare. I mean,
It's not like you call
I've
up and be like, "Hey, I want to take advantage of this month's special." It's very
I've
unique individual situations.
I've only dealt with this probably, I would say, off the top of my head, one time a year in the last 15 years, and it's almost always a death or a nasty divorce. It's one of those two. This one is really fascinating because, they structured it through an SPV, which makes sense. Like, even my AngelList
Hmm.
syndicate is an SPV. One of the benefits of an SPV is that, the participants in the SPV are not actually buying the underlying security. They're buying the rights to the proceeds of that security. So
Right.
in other words, when you're invested in an SPV, you can you can trade units of that SPV without triggering SEC rules around, the sale of securities and stuff like that. So now that I've said all that, my hypothesis is that one of two things is happening right now for this to get reported. Let's be clear. It's got enough volume happening in terms of transactions to now be reportable, right? So now that's why TechCrunch and all
Yep.
these guys are picking it up. So makes me think that one of two things is happening right now. The first is that the existing portfolios of these GPs may have gotten too concentrated in a certain sector or a particular company.
And when you say concentrated, just to clarify, with the values going up as high as they have, that creates this sort of, imbalance, if you will.
Yeah, you don't want to be overweighted as an investor in any
Good
one
word.
company because it introduces way too much risk sometimes. Just for people listening here, like if I told you that my portfolio was worth $1 billion, that might raise some eyebrows. But if I then told you that 800 million of that is actually one portfolio company, that gets a little bit, that can raise some nerves. So anyway, I think what could be happening is one of two things. Either the existing portfolio is too concentrated and they need to kind of like rebalance it. The LPs, to be clear, the LPs want to rebalance it, which is why they might want to sell those shares to somebody else. Or the other side of it is that the valuations have gotten so high that selling on these secondary markets to get some liquidity is worth it. Not only in terms of like cash in your pocket, because it's, you sold it, but also like if you think about the game that all venture capitalists play, it's really about measuring internal rate of return. I mean, over time, cash on cash return is the ultimate metric of whether or not a fund is successful. But those dollars don't come back very often. So the reality is that in between those big cash events, you're really looking at portfolio markups and stuff like that, IRR, internal rate of return. So the other thing that could be happening here, potentially option two, is that they're generating a little bit of liquidity to game that IRR number. Because, when you think about portfolio markups, you and I have done this with, for example, your own portfolio, where we've actually
Right.
started to measure IRR. And when you start to do that, the timing of the cash flows really can move the needle on that IRR number. So anyway, I'm rambling here a little bit, but let me just summarize it by saying that in a normal venture capital fund, a VC selling some portion of their their shares in successful companies would be a massive red flag for LPs. And the fact that it's not being talked about that way tells you something else is happening here. And again, I think it's either too much concentration on the LP side, or liquidity for the investors, or like the ability to kind of use that transaction as a way to justify the markups as well. So let me pause there. I don't know if I probably went too far.
No, I think you outlined it well, and I'm going to read one comment from the article that I think is very telling of where we are in this ecosystem, and it leads to a comment that I made to you about pickaxes, if you will. And it says, for example, shares in Elon Musk's XAI were plentiful, according to Anderson. XAI raised a part of its capital in its latest $6 billion round through SPVs, I can't talk today, that in some situations had a 5% upfront fee in addition to management fees and carried interest. So breaking that down for a second, what we're saying is that whoever bought secondary shares paid 5% to the person organizing the SPV, so 5% of whatever the value of this was, which was probably pretty massive, on top of the fact that they were then going to continue to pay management fees. I don't know what those management fees are, but they can be 2% of assets under management, and then carried interest, meaning they still get a piece of the upside. So essentially, like when you and I invest in something, we say, like when we invest directly, we have our own overhead costs. And so like we typically, as a firm, my partner Russell and I, we typically prefer to invest directly because we feel like it can be hard to overcome the fees associated with a fund. And so like a typical fund, we talked about this in the show before, might follow a 2 and 20 model. 2% fees on an ongoing basis for capital under management, and then 20% of any profit. So what's happening here is a VC has gotten a big run up in a stake on a portfolio company. And they're able to say, all right, I'm going to get an immediate 5% profit on whatever I sell here because they're going to get that cash for the, well, maybe not 5% because there's probably some fees to the SPV, but they're going to get some profit immediately. So they're not only are they cashing out some of their stake at a higher valuation, they're also capturing some cash at that moment. Then they're going to earn ongoing management fees. In some cases, they could be earning management fees twice. And then on top of that, they still get a portion of the profits if the value in the AI company continues to grow over time and has some sort of an ultimate larger exit. And all of that combined, like all these spots for them to make money, just made me really start feeling like we talk about like the California gold rush, where the people that sold pickaxes to the miners were the ones that made a bunch of money, and most people who came to mine for gold never really, got any gold. And
Right.
I think this goes back to this philosophy of in this kingmaker world, or if you want to say power law, where the big companies are going to be the ones that survive. Microsoft, Amazon, those are the ones that are going to succeed in AI. You kind of have to hope that in this sort of a model, if you're the other side of this and you're buying in and you're paying an upfront fee, and then you're going to pay a management fee, and then you're going to pay carry, you have to hope that not only does your company thrive, but that you're ultimately one of the ones that gets acquired by one of these big boys, or somehow breaks through and is the independent king, the Google, if you will. And it's just a lot of hurdles to overcome to
Right.
really have a real return.
Well, if it makes you feel so, you're actually right about all that stuff and the complexity of all that. One of the main terms that has been used, and I remember having to deal with this a lot in the past, is like it's called carry on carry.
Yep.
What
Yep.
LPs don't want is you know, hypothetically for you as an investor to use their money to initially get into a deal, but then use like the investor's clout to then create an SPV and then roll up even more investors. Because if in theory you were to then get, let's just say there was a liquidity event as an investor, you're getting, let's call it 20% carry from your direct LPs and then potentially 20% carry from your other LPs. Technically, it could be argued that, you use the original LP's money to generate that deal and to get the cloud. And so anyway, that whole bucket of issues is generally referred to as carry on carry. It's messy. I think we're kind of in the Wild West right now. I think that, a lot of people don't realize that convertible term sheets aren't like 100 years old. They're like, I'd have to go look it up, but the venture capital business is like only 50, maybe 60 years old, only with, but so convertible notes have been around. I'm sorry, let me rephrase that. Equity documents are really only 50 to 60 years old. Convertible note documents are only maybe 2 decades old, maybe 3. Like
Yeah.
but we're pretty sophisticated now as an industry about what those convertible notes should look like, what they shouldn't. SPVs, we're probably only about 10 years into that. And so there's still a lot of messiness about, where does the carry go? Is the GP, how does fiduciary duty work here if you're the GP of a fund while also leading a syndicate? That gets really messy really fast. But anyway, that's like a whole different ballgame that we can talk about. But I think this is going to be like really interesting to watch over time too, because generally speaking, fiduciary duty, let me say this a different way. As a GP of a fund, I had to go sign a lot of documents and explain that I understood that I was taking fiduciary responsibility over this money and subject to
Right.
SEC oversight and all that stuff. I mean, obviously with some caveats, right? Fast forward, and that was like in 2010, maybe, when I signed my first doc like that.
Yep.
Here we are doing a syndicate that I opened up like 2 weeks ago, and I'm sure I clicked a button somewhere that said I have to take fiduciary responsibility of this money, but it clearly wasn't bolded and scary looking enough for me to remember it in this moment to you. And that's amazing and terrifying that like almost anybody in theory can now start a syndicate and manage other people's money. And I don't know, like it feels like the industry is still early because the SPVs I think are largely self-policing themselves. And maybe the platforms are self-policing. So we'll see. But anyway, it's really interesting to see the shares getting sold. And I think the reason we're talking about this is to your broader point about the gold rush. and I think we've been saying this for a while, is that like AI, the way that people talk about and invest in AI today is kind of how it was when blockchain was the big word, and then it was like, I'm trying to think of what other fads there were in the past, 3D printers, and the tricky part is this is a power law driven industry. There's only going to be two or three players that end up eating all the market share. And chances are they've already been invested in. Let me say this last thing. I promise I'll stop talking about this. I think when we started texting about this particular article, the immediate thought that came to mind for me is that if you're here to make money in venture capital, the unfortunate part is you either need to be very early and right or very late and right. There's no money to be made in between. So, that's why some of this stuff is getting sold, is that, the people that were early and had conviction and took the bet have probably already scooped up a lot of the equity that's available. And now you got to wait to the other end of the spectrum and see if who emerges as like maybe the potential market takers and try to be late and right into those deals. So
Yeah.
we'll see.
All right. So to wrap up this week, just a quick follow up on our OpenAI story that we talked about recently. We talked about this unique, I think is probably the most euphemistic way to say it. This unique clause inside the OpenAI severance docs that says essentially you can't disparage the company in any way, shape, or form after you leave, or you would lose your vested equity. And you flagged this tweet from somebody named Jacob Hilton. And he said, when I left AI a little over a year ago, I signed a non-disparagement agreement for no other reason than to avoid losing my vested equity. And I'm going to skip ahead in the thread for brevity. He said, yesterday, OpenAI reached out to me to release me from this agreement following Kelsey Tuoch's excellent investigative reporting. So I think it's interesting, and I have a follow-up on this too, but I want to get your take first. I think it's interesting that OpenAI went ahead and proactively reached out to folks that left the company to advise them. And I'm wondering what your thoughts are there.
Well, I mean, I think when we talked about this a week or two ago, I think that the summary here is I think OpenAI is in damage control mode. And one of the things we talked about on that particular episode was that the way that I think Sam Altman's statement was not interesting in what he said. It was actually interesting in what he didn't say. So in other words, his statement to appease the wrath of the mob was actually a non-statement. And I think, I don't know, like even this particular thread, it sort of feels like what this person I think is kind of going through or potentially going through is in the category of things that was not clarified in Sam Altman's statement. So let me pause there. Where do you want to go with this one?
No, I think that's a good point in that the fact that they're doing, like, I think Sam Altman's statement was a bit vague, and I'm definitely excited to see it. I think what was interesting in the thread, like, first off, I mean, going back a second, first off, like, this shouldn't happen. If you have vested equity in a company, it's vested equity. Barring fraud or gross negligence, it's your equity. And the reason why I feel strongly about that is, as you well know, not in every case, but in many cases in Silicon Valley, Silicon Valley, but in the startup community as a whole, you're earning less than market pay, and your vested equity is the rest of your compensation. It's not always the case, but I mean, that's your upside. And
Right.
So if you can lose that, then it creates even more risk in jumping into a startup. And I think this is a fact that's not well understood by a lot of folks who go to work for startups. And I think it's also enunciated in this tweet thread, because he goes on to say, I believe that he says that even now, OpenAI can prevent employees from selling their equity, rendering it effectively worthless for an unknown period of time. Given that OpenAI has previously used access to liquidity as an intimidation tactic, many former employees will feel scared to speak out. I think what's interesting there is, look, I mean, I think you know this just as well as I do. For the vast majority of startups out there, it's not an intimidation tactic. The shares are illiquid. They're not publicly held companies. And I think if you're working for a startup and you don't realize that you have a long tail asset or an illiquid asset, you should really realize that soon.
So yeah, I'm glad you're bringing up this portion of it, because the flip side of this particular tweet thread is it might also be turning into a he said, she said. The if I'm reading this one right, what he's referring to is typically it's the jargon I've heard it called is the ROFR. It's the right of first refusal.
Yeah.
So there is a legitimate reason why a company would want to have a ROFR covering their equity, even if it's vested. There's a reason they would want that because, and I'll make this up for the sake of time. Let's just say you have an employee that owns 0.01% of the company. Let's just say that's the case. And let's just say they've vested, for the sake of easy math here, let's say they've vested 100 shares and the company has 10 million shares or whatever, right? And for the sake of this hypothetical, let's just say that that employee unfortunately needs cash for some reason, divorce, home purchase, whatever.
Yep.
If that person were to then go and let's say call me and say, hey, I've got 100 shares of pre-equity or pre-IPO equity of Acme Corp, and I offer him a price or her a price of, and I'm making this up, 10 cents on the dollar, and they accept, well, that is a sale of securities that not only has to be reported, but that sale now, or that sale price can be used to potentially cause a lot of headaches for all other shareholders because it's anchored the price somewhere that the price may not need to be. In other words, the strike price of that equity might be $5 a share, but because this one person needed cash so bad, they agreed to be paid 10 cents per share. The IRS and the SEC might say, well, hang on a minute. There was a liquidity event here. I know it's only for 100 shares, but we might believe that the overall shares are overvalued. And now you got a headache for potentially hundreds or thousands of other people. So there are legitimate use cases here for why you would want to prevent that. And so I guess what I'm just saying is that the flip side of this mess now, let me just cut to the chase. The best thing I think anybody could do at this point is actually post the documents. Because if they could just do that, even if you redacted all the names and the prices and all that, if we could just see what the clauses were and how the legal language was structured, we could start to figure out which parts of this are potentially retaliatory or worse versus which parts are actually normal business operating rules that are being misunderstood by unsophisticated people. So
yeah. No, I think you nailed it. I think you nailed it. All right, well, man. I think that's a good place to pin it to get you to the rest of your day. What are you? You said you're like contemplating trips. Are you just dreaming, or is there? So I haven't told Dana this, and I don't think she listens all the way to the end of the episodes. Maybe we'll see. Does she listen? Because my wife doesn't listen at all.
I've caught her listening, so she might not admit it, but I've caught her listening. So I'm thinking about doing like a quick trip down to St. John for a weekend and surprising her with that this month at some point. And then we've got, we're starting to lock in all of our summer travels with the kids and that sort of thing. So yeah, but we're going into summer season. It's my favorite, the pool's open and adventure awaits.
Yeah, and you guys might be coming to jump in my pool soon too for the graduation party. You guys are coming.
Yes, we are actually. I forget the date. We won't mention it on the air, but I know it's coming up here soon. And I'll apologize in advance for my feral children that will probably run amok across your house.
We have tons of sugar for them and tons of wine for you and your wife. So it should work out just fine.
Any travels this week for you?
Nope. I'm home, blessedly home for at least a week, but then I'm back out the road after that. So.
Love it. All right, man. Well, have a wonderful week, and I will talk to you here soon.
Sounds good, man.
All right. See ya.